I sure hope. All right. So, hey, everybody. Hey, we're back for part two, back to see what is option selling all about. I know that in Impact, we usually um, do a lot of with option buying, which is actually one of the reasons why I joined Impact. Almost 2 years ago now. Feels like a year and a half ago. I feel like I've been there a while. I'm part of the family. I joined because I wanted to up my own skills. I have a community of my own that many of you know about, but I wanted to up level my own skills. So I joined the community. I thought I was going to come into Impact, like fly under the radar. I was just going to sit on the sidelines and watch a little bit. And I was on the first night I was on the call. Somebody asked a question about something to do with selling. And JT was like, well, Arlissa's on the call. She's here for selling. Arlissa, can you open your mic and answer? AP, I think he said, I was like, oh, well, I was just trying to listen. But it started off from there. I love it here. I love it here. That's what you need to know. I've met TJ and JT in person. I went to Charlotte on my own dime and my own time so I could go meet the people in person. I wanted to feel their vibe. So I went and met them so that way, because I would like to feel the energy of the folks I'm gonna be working with. So here we go. Who is AP? Who is Arlissa? That is me. I'm a wife, I'm a mama, I'm a grandmama, I'm an author, I'm a digital creator, I'm an entrepreneur. Actually, I'm also a great grandmama, if you believe that. I'm a mechanical engineer by degree and profession. I graduated from Tuskegee. Woo. I'm a math professor by degree and by profession. I teach at the University of North Florida here in Jacksonville. I'm the founder, CEO of Educator to Trader. It's been in the force for about officially 3 years, but I've been working for 4. I'm stock and options trader and coach, and I am a daughter of the king. I am not a trading professional. I am not an expert. As I just said, I was still learning, and I'm not a financial advisor, so nothing I say is going to be financial advice. Okay? Okay. The topics I'm going to cover tonight are what is option selling. I'm going to hit a quick recap of that from I'm going to hit a quick recap of that from 2 weeks ago. We were here 2 weeks ago. I'm going to talk about how do we sell options. I'm going to go through the strategies. So if you're looking for more foundation of option selling, that'll be in part 1. I'm not going to replay part 1. I'm just going to go ahead into the strategies after I hit, a quick overview of option selling. Basically, option selling is the opposite of option buying, which is what primarily we do in Impact. Is you do option buying. You buy calls, you buy puts. You buy calls thinking it's going up, you buy puts thinking it's going down. Well, there's a person or somebody in the overall world of options. Somebody has to be on the other side of that trade. It's just like, you go to a store to buy something, there is somebody selling it to you, the store owner. Every transaction has a buyer and a seller. Same thing's happening with options. That's no different, right? You're entering these trades as a seller. You're using the bid column, which many of y'all probably know the bid column was even what that was even for. You're used to hitting the ask column when you're selecting your strikes, but the bid column is for us sellers, right? When you're a seller, you receive money, you receive premiums when you enter. Like when you all are, when I say you all, because primarily I'm not a buyer. So when I say you all, I'm kind of talking about the general you all. So don't feel no type of way. But when you're buying options, you have to pay to play, right? But when I'm selling options, I'm going to receive. When you're a seller, you're going to receive premiums. So you get paid to play, basically. You're leveraging your collateral in order to make profit. So though a seller does not pay any money to enter the trade, what I do is put my collateral up, almost like a deposit. Like if you go rent a car, you have to put a deposit up on the people's car until you take it back. And then when you take their car back, it's all safe and sound, they give you your money back. Same thing happens with a seller trade. When I enter a trade as a seller, I put collateral up for the trade until that trade is done and successful. If it's successful, I get my collateral back. If it's not successful, they keep it. Same thing as if you rent a car. You rent a car and you wreck it, they keep the deposit, right? Same thing happens. Option selling is when you offer someone else the opportunity to buy or sell a stock at a certain price in the future. So if you sell a call option, so now you're going to have to flip your brain from the buying concepts, right? When you're buying a call, you're expecting price to go up, buying a put, expecting price to go down. But when you're selling a call option, you're promising to sell the person the stock at the price that you sold it at. You're promising to sell them that stock at that price. That's when you're a seller, you're releasing stock into the market. You're saying, okay, I will sell you this stock at this price, and you're going to give me a premium in the meantime until it's exercised, or if it doesn't work out, then I have to release the shares to you. And if it does work out in my favor, I get to keep my stock and I keep the premium that you paid me. Okay, if you sell a put option, then you're promising to buy the stock from them at that price if they choose to sell it. So when I'm selling a put, I'm receiving. That's kind of backwards. I'm selling a put, but I'm saying I'm willing to buy, I'm willing to purchase or receive 100 shares of stock at this strike price. And we'll talk more about that in a minute. In exchange for making this promise, you're going to receive a payment up front, which is called a premium. Sellers get paid to play. You get paid to trade when you're a seller, which is different than when you're a buyer, right? When you're a buyer, you got to put your money up. When you're a seller, the money comes to you first. Okay, so let's talk strategies now. I've got 4 strategies. I'm going to go through actually three strategies, and like a plus, I'll do three and a bonus. It's not really a bonus, but it's like the expansion of one, but it's really just 3 strategies. Okay. Cash secure puts. Selling cash secured puts, and they are exactly what they sound like, cash secured puts, right? Many people call it selling puts. But cash secure puts is basically when you're going to sell puts and you're going to secure that trade with your cash, right? This is a bullish or a neutral strategy. This is when you think the price is going to go up, or at least is going to stay flat or neutral above your strike price. I call selling puts a no-lose strategy. And the reason I call it that is because you're either going to win with the premiums, because you're going to receive premiums when you enter this trade. You either win with premiums, or you win with premiums and the shares. So if the trade goes your way, the way you want it to, and price stays above your strike, then you're going to keep your premiums. If the trade goes and the price comes down and it breaches, or it expires, really more than breaches, it has to expire below your strike, then you're going to receive the 100 shares of stock at the price that you said you were willing to sell the put at. Okay, you select premiums when you enter the trade. This strategy is used to acquire shares at a desired price, or you can use it to generate income. Some people just use the strategy for income, but you can use it to get more stock of something. So you should really only trade this strategy when you want to, on a stock that you really want. You shouldn't just do it just because you want the premiums. You should do it because you want the stock. So let's do an example real quick. On the stock, one of the ones y'all been looking at, we've been looking at a little bit, because I've been looking at it too, is Wolf, right? So Wolf is in the $3 or $4 range right now. TJ, what's the price of Wolf right now? I just turned on my cash secure put today. You think I would know exactly what the price is? I'm looking at my phone so I can see what it is. Wolf is currently $4.11. Okay, so the current price of a Wolf is $4.11. So let's say you want some shares of Wolf. You want to get some more shares of Wolf, but you don't want to come straight out and pay $4 or $411 for 100 shares. Then you could sell a put, right? You could sell a put for $4 at the $4 strike, right? And you could sell a put at the $4 strike for this Friday. Yep, this coming Friday, and you would collect $42. Soon as you enter this trade, the broker is going to automatically, immediately give you $42. The collateral you have to put up for this, right? There's some collateral, like your deposit, like we were talking about, is going to be the strike price that you have, which is your 4 times 100 shares. So that's going to be 4 times 100 is $400 minus the $42 that they give you. They're going to give you $42. So the collateral required for this trade is $358. Okay. You're selling a put on Wolf for at the 4 strike. You're going to get $42 immediately. The collateral, your broker is going to block up $358 of your buying power. They're going to keep that off to the side until this trade is over. So at the end of the week or Friday, if Wolf expires above $4, so let's say Wolf expires above $4 on Friday, right? You're going to keep your $42 and the broker is going to release your $358 back to you. They're going to give you your $358 back. They haven't spent it anyway. All they did was block it away from your buying power. Okay? If price on Friday expires below $4, and you're still in the trade, by the way, because you could always buy your way out if you didn't want the shares. But if it expires below $4, you're going to still keep the $42, and you're going to be given 100 shares of Wolf at $4 a share. $4 per share. Okay, that's how that works. If the price is above $4, you keep the $42 that you had. Basically, your trade ends up expiring out of the money, which is where you want to be. When you're a seller, you want to be out of the money. When you're a buyer, you want to be in the money. Seller, you want to be out of the money. If we expire below, if Wolf expires below $4, you're going to still keep your $42 and you're going to get 100 shares of Wolf at $4 a share. It's a way. Now you could just bought your shares of Wolf today for $411. You could just go and say right now, I just would rather have my shares. I just buy them for $411. But if you go with the way on Friday or go with, this second way and you end up with them, you're going to basically end up having to pay. You're going to have paid, received $400. You're going to have paid $358 for them basically, because you received $42 for something that you paid $400 for. So the price to you is going to be $358. You either can buy them today for $411 or end up with them potentially on Friday for $358. Make sense? And this can be done on any stock. Just remember that it's going to be the strike price that you pick times 100 shares is the price that's going to be used as collateral. This is the way that you can acquire, grow positions or acquire more shares. It happens in buckets of 100 because every options contract is 100 shares. This is why, too, you want to trade. You want to do this on stocks that you want to own, just in case the stock does end up lower than the price on Friday, or expiration does end up lower than what your strike price is. You'll end up with shares of something that you actually want, right? I'm using doing several cash secure puts right now on stocks that I have a higher cost basis. So for example, I've got SoundHound at $12. Well, I need to bring the cost basis down. I have Rigetti, I think, at $12. Well, Rigetti is now worth $9. So I'm selling cash secure puts. So if I get assigned, I will be able to bring my cost basis down. But in the meantime, while Rigetti is doing its thing, I'm collecting premiums in the meantime until it ends up expiring lower than one of the strikes. But I'm collecting good premiums along the way. So by the time I do end up with another 100 shares of Rigetti, I'm going to have paid for a portion of those shares in premiums along the way. All right. When do we sell puts? You sell puts when you want to acquire shares at a lower price, or you want to capitalize off a bullish movement as a seller. If you're just doing it for the money, and there's a bullish movement, you can sell puts against it. And then as the price rises, you get to keep the premiums and you don't end up with the shares. Okay, how do we sell puts? You can select the strike at or below your current price. Your collateral required is the strike price times 100. You win the trade if the price is above your strike at expiration. These can be done in a cash account. I realize many of us in Impact have a cash account because we want to be able to open and close options contracts. So you use a cash account. You can do cash secure puts in a cash account as long as the cash is there. Long as you have enough collateral in there to cover this trade, you can do them there. If price expires below your strike, then 100 shares will be put into your account. There is actually nothing for you to do. If you are still in the trade and it's not closed, if you haven't closed it off, then when expiration comes, then overnight or over the weekend, usually you'll end up with your 100 shares in your account. They'll just magically show up. All right. Do we have any questions on cash secure puts or selling puts? There's some pros to selling puts. It's a very passive strategy, very passive. You basically select your stop, select your strike, and I don't know what happened there. Select your stop, select your strike, and let it run through the expiration. If you want the shares, you know, and then if it ends up going the way you want it, fine. If it ends up coming down and going into your strike, then that's fine too, because you wanted the shares anyway. You win in all the situations except one. I'll talk about that in a minute. And it's a great use of the money that you have just sitting in your portfolio. Many of us have portfolios, got good little size on them, got some stuff. Maybe this is over in maybe in your 401k, maybe in your IRA. You got money that's just sitting there. You're not trading options with it, but you would like to maybe acquire some more shares with it. One thing you could be doing is using it to sell cash secure puts. And then if you acquire the shares, then the shares can just sit in that account too, right? You already have them in there. The cons to selling puts is if the stock actually tanks, then you can be left holding the bag, but you will still have the asset. So you're not really just holding the bag, you're going to have an asset because we know that the shares is the asset. So even if the stock price, let's say we were given the Wolf example, even if Wolf goes down to below $4, maybe it goes into $3. If you believe in the company, you believe in what they're doing, even if the stock drops, the stock price drops, and you believe in the longevity of the company, then you're still going to have your 100 shares, right? And sometimes people say cash secure puts require a lot of capital, and they do, they can, because if you wanted a bigger stock, let's say you wanted to do, $100 stock, then you need to put $10,000 onto a cash secure put trade. So it's going to require you to, have the capital that you need, or be picking stocks that you're okay with. If you're, or lower price, when I say lower price, you may think something that's less than $30 or $40, because a $30 stock times 100 is going to be $3,000 worth of collateral that has to go onto that cash secure put. All right, but if it's a stock you want, then you're still in good shape. That's cash secure puts. Let me see if I got any questions over in the. Nope, we're good. What criteria do you use to select the strike for the cash secure put? I usually pick the strike right below current price. Sometimes I'll pick the strike right below. Sometimes you have been watching me on any of my recent social media posts. I've been talking about doing offensive cash secure puts, which is basically selecting the one that's right in the money. Sometimes I'll select at the money or in the money, because if that's still lower than my cost basis, if I end up with them, that's fine. But should you get better premiums, the closer you get to current price, the better premiums you get. So I figure, if I go up, if the stock price, for example, is at like 430 and I sell a put at the 4.5 strike, that's in the money by 20 cents. Maybe it'll be there at expiration, maybe it won't, but I'm gonna get 20 or 30 more dollars just by being 20 cents in the money. I think it's worth it. So I picked the strike. That's a good question. I picked the strike generally right below it. If you're trading it for income though, that's me doing it if I want the shares, if I don't care about getting the shares. If you're really trading it for income, you may want to go down to maybe a 20 or 25 delta. You won't make as much in premiums, but you won't have to be worried about getting the shares either. So that it depends on what is your what is your plan for selling puts. If you're selling them for the shares, then pick a strike that of a price, the strike price that you don't mind paying. But if you're doing it for income, then pick a strike that you don't think price is going to come down to, so you won't end up with the shares. You're welcome. Good question. All right, strategy number 2. What are covered calls? Selling calls is a bearish or a neutral position. You do need the 100 shares or a long call for each covered call contract that you sell. So if you end up with 100 shares of something, for example, Wolf, that was the example we were just using, you end up with 100 shares of Wolf, you can then from there start to sell covered calls against those same shares as the price rises. So you're making money off your asset while you wait for the price to climb up, right? You collect a premium when you enter, just like you did with cash secure puts. Select a strike above the current price and above your cost basis. You want to be above current price and above your average. So you want to make sure that if they get called away, at least you'll make a profit if they get called away. Price has to expire below your strike price in order for you to keep the premiums and the shares. So if you pick, for example, a 5 strike on the Wolf and price expires above 5, you're going to release your shares to the market at $5 a share. If price expires below the 5, you're going to keep your shares and you keep the premiums. If price expires above your strike, you're going to keep the premiums, but you're going to have to release your shares, which means they're being called away. The covered call, they're going to be called away, and it's just going to happen. There's not going to be anybody who's going to send you a note asking you if you want them called away. They're going to be gone. All right. All right. When do we sell covered calls? You sell covered calls when you have 100 plus shares that you'd like to sell for break even or a profit. If you have shares, you don't mind releasing them. You're okay to release them back to the market. Perhaps you're doing the wheel strategy. This is your strategy to get them, acquire them, sell them for higher, buy low, sell high. If that's your strategy, that's when you want to do covered calls. You want to sell covered calls when you have 100 plus shares that are slowly rising and you want to make profits along the way. But you don't want to lose these, but you want to use them as an asset. Perhaps you have shares like SoFi, not moving fast, but you want to make some money off of them while you continue to hold on to them, right? You still want them because you got good belief that they're going to come and go somewhere one day. But you want to make some money while you wait. Yes, you want to make money while you're waiting. That's when you would sell covered calls. I'm doing all this because I have shares of SoFi that I sell covered calls on while I wait. Okay. You sell covered calls when you want to trade the wheel strategy, which basically means you sell puts, acquire the shares, then sell calls, then release the shares. That's the wheel strategy. You sell covered calls when you have dividend stocks that you can make covered calls premiums and dividends off the same asset. If you have dividend stocks, you can do both. You collect your dividends and collect covered call money. You also want to sell covered calls if you have a long call or a leap on something and you want to sell covered calls, you want to collect profits from it while you wait for that leap to expire. Maybe some of you may got something into 2026 or 2027, and while it's growing, you want to sell covered calls against it while you wait. These are all scenarios in which you can sell covered calls. And I know we got some people who got shares just sitting around. You might as well make a few dollars off of them while you wait. Right? You want to select the strike price at or above your cost basis. Again, you're using the bid column because that's where the sellers reside. Collect your premiums. The money is opposite of buying. We sell high and we buy low. You win the trade if the stock price is below your strike at expiration. You can buy to close anytime. So if the price is getting too close to your strike price or it gets past your strike price, but you don't want to release your shares to the market, you can always buy your way back out. All right. This can also be done in a cash account if the shares are also there. So you can't have shares in an IRA and you want to sell covered calls over here in this cash account. They got to be in the same place. You can't do covered calls on shares that are someplace different because the broker's like, okay. I mean, even within the same broker, even if you got Thinkorswim and you got multiple accounts, if those shares are not sitting in the same account where you're doing the covered call, it won't work. Okay, they have to be in the exact same place. And the reason is because if they get called away, they want to know where to call them from. and they will call them. Yes, they will. They will call them. All right. Do we have any questions? Any questions? There's some pros to covered calls. It's a great way to profit from your asset or your shares along the way while you're holding shares of stuff. You got positions. It's a great way, especially if you've got lower cost ones that pay good premiums and you've got buckets, maybe you have 4,000. Anybody here got 4,000 of something? Maybe you got 1,000, maybe you got 100, maybe you got 200, whatever. Maybe you got 500 and you sell covered calls against some of them and you save some to not sell against. Maybe you just sell against some of them just in case something goes on, right? But it's also a very passive strategy where you sell covered calls against them and just week after week you continue, and you can go out 2 weeks or 3 weeks. You don't have to be every week, you don't have to do it, but you can do, you can go out a month and sell covered calls, get better premiums that way. The cons of covered calls is your shares or your asset could be in danger of being called away if the price expires above your strike. So if something happens, for example, SoFi had earnings this week, right? It was this week or last week. SoFi had earnings. If I was selling covered calls against them and they did have earnings and the earnings popped past my strike and stayed there at expiration. None of these things happened, by the way, but if that all happened and it stayed up there, then if it was past my strike, I would have released my shares to the market at expiration day, right? Just so happened that they did pop, price did pop, and then it, popped and dropped, which happens with SoFi seems to happen. But if you have shares and the price jumps past your strike and expires that way, you will release your shares to the market. So that can be a drawback. So what many people do in that situation is when you're going to have earnings coming, you just don't sell covered calls against your shares during the weeks they have earnings or something that could potentially cause the price of your shares to pop up. That's the way you do that. Okay. Otherwise, you close them. You can always buy your way back out. Buy to close. This is the wheel strategy I was just talking about. It includes the cash secure puts. You sell cash secure puts, you get assigned the 100 shares, then you sell covered calls, and you do that until they get assigned or exercised, whichever. There's two different words. One of these is exercised and one of them is assigned. And then when you're exercised, you lose the shares and then you can start the process all over. It's called the wheel. It's a whole strategy. People use it regularly to make premiums and to acquire shares. All right. Pausing for the cause. Anybody got anything they want to question or add on those two before we get deeper into credit spreads? Let's get deeper and deeper into credit spreads. We're good? Okay. We'll keep plugging along. So, credit spreads. Credit spreads is a variation of selling and buying all at one time. It's called a spread. It's basically selling a contract and buying a contract simultaneously, which is a spread. Put credit spreads are bullish, just like cash secure puts. We're thinking things will go up. Call credit spreads are bearish, thinking things will go down, just like covered calls, bearish or neutral. There's collateral required, which is less than doing cash secure puts. A one spread is $100. SPY is a stock that is a one spread. Triple Q, I think Nvidia is still at a one spread right now. And when I say one spread, when you see the strike prices on the option chain, if there's one, point or dollar between those strikes, that's a one spread. One spread uses a collateral of $100. A 2.5 spread is $250. A 5 spread like SPX charges or uses 500 in collateral per spread that you enter. Your collateral is $500 minus whatever premiums you take in. Again, you collect premium when you enter. When you're a seller, you collect money to enter. You do not pay to enter. You receive money to enter. The same money that you all are paying to enter trades is the money that the sellers receive. Of course, the broker takes some in the middle, but yes, that same money you paying, somebody on my side is taking that money. When do we sell credit spreads? When you believe price is going to stay away from your strike. We're trying to stay out of the money. When you're a buyer, you're trying to stay in the money or get in the money. When you're a seller, you're trying to stay out of the money. You're a sell credit spreads when you don't have time to watch for perfect entry or exit. I love buying. I kind of like it. I like that what it gives, but I do not like that you have to enter so perfectly and you have to exit so perfectly, because I've had good trades going, good trades. And then I stepped away, walked away, changed the screen, did the job they paid me to do, and I came back and my exit, I had missed it. Like missing the exit on the highway, and you can't turn back and go get the right exit. Sometimes it'll give you a second chance, but sometimes it won't. When you sell credit spreads, you don't got to be worried about it like that. Ooh, thank you, Jesus. Thank you, Jesus. And you want to enter just like you do with buying. You enter as prices leaving support and leaving resistance. Same kind of situation there. But your entry and exit don't have to be so laser and so strategic. It's strategic, but it don't have to be so laser focused. Cause you miss a buyer entry, you missing it by 3, 4, 5 cent, 10 cent, the trade gone. You don't miss 10%. They up 10% and you trying to, is it still too late to get in? Yes, it's gone. The trade is gone without you, sis. It left the station. Oh my goodness. Okay. So how do we sell credit spreads? First thing you want to do is determine support and resistance. The sale line or the sale contract is the most important. That's the one we don't want to be breached. We're going to go with the vertical under the spread, under the choices of the thing. And you want to collect your premium. The trade wins as long as the price isn't beyond your strike at expiration, or you can buy to close it. When you got the profit you want, you can buy to close it. This strategy, trading credit spreads, does require a margin account. You have to have a margin account. This cannot happen in a cash account. This has to be in a margin account. Okay, most of us have margin accounts. You need to have a margin account and be able to do spreads. Some people have margin accounts, but you got to have the level, which is either level 2, I think, on Thinkorswim, level 3 on some of them, but you need to have the level to be able to trade spreads. It's not hard to get. So if you don't have it, it's not like it's some, fantastic thing to have. You just have to answer the questions that they ask you, which the questions are for their protection and not for yours, believe me. So just know that. I put this list in our I'm saying what Telegram. I keep wanting to say Telegram because that's what I have in my community. But I put a list like this in the Impact chat. There we go. In the Impact group, I put something like this every week. And some of y'all probably looking at it like, I don't know what this is and what this means, but I'm getting ready to explain it to you. I'm gonna explain it, okay? So the put credit spreads I just was talking about, those are bullish. Price needs to expire above the second number. Okay, price needs to expire above the second number if you're going to do put credit spreads. This is a bullish or neutral strategy. Price needs to expire above the second number. This is from November. And the call credit spreads, like selling call credit spreads or selling a covered call, is bearish or neutral. Price needs to expire below the first number. So what it is on the call credit spread. If I do iron condors, which I don't really put them on there like this anymore, I now separate them off. If I put the same thing like this week's list, I put the same thing, but I put it on both lists. I do that now so that nobody gets confused on what they need to do with the call with iron condors. People get stuck sometime onto what an iron condor actually means. So I'm looking here for the one for ours for this week. So that way I can show you. I don't really put it as iron condors anymore, but if you have an iron condor, the price needs to expire between the 207 and the 217, right? This is the one I put in our list. I put in our chat for this week. And notice Microsoft and Triple Q are on both lists because they showed up as a neutral trend for the week. So I put it on the put credit spread and the call credit spread list for whoever was trading them. They can trade them from either side or both sides. Actually, my community entered Triple Q today as an iron condor. We're doing both sides because it's still showing neutral on the 50 period moving average. We'll see. We'll be there a couple days or a day. We'll just gonna be there a little while. We here for a good time, not a long time, right? But this is what this list looks like. Put credit spread bullish, call credit spread bearish or neutral, expecting price to stay below this first number, expecting price to stay above this second number. So now you got a little bit more idea of what this all means when you see it. Okay? What's going on there? Now, if you want to make even more money with credit spreads, trade the iron condors we were just talking about. Trade the call credit spread and the put credit spread. When you do a combination of them both, you basically are using the same collateral, but you receive both sides of the premium. So for example, let's talk about the trade. I just was mentioning today that we did Triple Q. So we did Triple Q today. We did a put credit spread today. And I want to say it was 472, 473. We did it at the end of the day while we were watching, the foolishness of the post FOMC. And then we did call credit spread. I want to say we did 485 if my memory is serving me. 485, 486. So for the 472, 473, we took in $22 in premiums. For the call credit spread 485, 486, we took in $33. All right. So this is a one spread. Between 472 and 473 is a one spread. Y'all remember what I said, a one spread? How much collateral is required for a one spread? Y'all remember? Who was listening? Yep, I see one person said $100. Very good. $100 of collateral for a one spread. Two people. Thank y'all too. Now, they gave us, as soon as we entered this trade, they gave us $22. So we're going to subtract $22. When we entered this call credit spread, they gave us $33. So we're going to subtract $33. What's that, $55? So the collateral that we have on the table right now is $45. That's our deposit. We entered the trade. We put our, initially we were going to put $100 up for collateral. They gave us $22. They gave us $33 more. So the only thing we have in the trade right now is $45. We need trade to expire where? Where do we need price to expire for us to keep our $45? Where do we need price to expire? This is a harder question. No, 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 no. Anybody gonna guess? No good guesses? In the money? Well, no, we want to be out of the money, but we got to see out of the money where. Anybody got? I see that. I thank you, Daniel. 474. That would be one place. Mm-hmm. Mm-hmm. Somewhere between what and what? We need price to expire somewhere between what and what? Daniel is on the right track. I think other people are just scared to answer. Between 2 and 3, almost. We need price to expire between 473 and 485. We need price somewhere in here, somewhere between 473 and 485. If price expires anywhere in there, our trade is good. Right? If it expires anywhere between these two numbers, we're going to keep our $55. They gave us 22, they gave us 33. If price expires between 473 and 485, we're going to keep our whole $55. They already gave us the money. Now we just got to see if we can keep it. Right? Above 473 means this trade is good. Below 485 means this trade is good. This is what happens when we have an iron condor. If you only have one side, if we had only done put credit spread, we just would need it to be above 473. If we had just done the call credit spread, we would just need it below 485. But since we did both, we now need the price to expire somewhere in this 12-point window. We need it to be somewhere in the middle. Somewhere in the middle. And if it expires in there, we keep our whole $55. And all we need is time decay. When you're a seller, time decay is your friend. Like I just said, we entered it today so we can be out by Friday. We could have entered it tomorrow. We could enter it on Friday. Time decay is our friend, which is why we can do 0 DTEs on SPX and whatever else we want to do, because theta decay is our buddy. It works for us. Works for us. So this is how you can make more money with iron condors. If I had just done the put credit spread, then what we would have made was $22 out of the 100, out of our one spread. More money, you do more contracts, that's how you get more money. If I had just done the call credit spread, then we would have made just the $33, which is plenty of money. $33 off of 100 spread, that's a 33% return, right? That's 33%. That's a pretty good return, and all you had to do was enter and let the time expire. Make sure it doesn't go above 485, and if it does, you just jump out. Put credit spread, if you're doing this, make sure price expires higher than 473 and just let time decay. If the price runs up, to wherever, it's fine. If you just were doing one side, you wouldn't care where it went above 473. You would take your $22, which is a 22% return. Pretty good returns for just letting time decay, just letting the time pass. Yeah. Questions here? All right, I'm getting ready to clear the screen, and we're gonna go a little bit deeper, and then we're gonna wind it down. Because if we get too deep, y'all will be like, "What? You are doing too much all in one day." Okay, now 0 DTE is where the money and the higher risk resides. Oh yeah. This is, I put that graphic in the chat into our Impact Telegram. I still want to say Telegram because that's what I talk about all the time. Into our Impact chat, I put that graphic there of the money I made for April. And that $8,600 for April came from the 0 DTE on SPX. And you know, there ain't nothing to sneeze at, right? A lot of people like credit spreads. You can't make that kind of money off credit spreads. Well, you can. Sometimes it take a little bit of extra, but it can be done, right? 0 DTE, cash settled. SPX is cash settled, so I don't have to worry about shares transferring hands and all those good things. You could also do it on XSP, which is a one spread. You won't make as much in premiums, but it's, you know, it's also cash settled. Sell credit spreads with strikes where you don't think price will go by the end of the day. So our job is to find the strikes that are not going to be where price will go today. So for example, I entered a trade this morning on SPX and I had 46.75, 46.80. And I had a call credit spread. Now, I entered it this morning. It might have been 10:30-ish. I did that because I felt like price wasn't going to push any higher. It had gone up a little bit. It did break out of the opening range, but it didn't break out with any power. And I saw it turning back. So I went with a call credit spread. I ended up using something to lock it. I used what's called a PDT hack to lock in my profits because I didn't want to leave this trade going into FOMC. But basically I could have, because the price never came up again to 46.75. I collected $90 per contract. I entered 46.75, 46.80, which is a 5 spread, right? I collected $90, which means I put up $410 of collateral. That's my deposit, was $410. I could have let this go all the way to expiration. I actually had 4 contracts. I could have let it go to expiration today, and I would have kept $360 just letting the time pass. Even though today was a lot of roller coaster riding, so it would have been a little, you know, a little bit scary. It never really got even close to 46.75, but I just wasn't fooling up with Romy today. You know, FOMC is not the day to be trying to ride or trade all day long. That's just not wisdom. But looking back at it, I could have, but I ended up closing it up for $40 for 4 contracts and made my $160, which I was extremely happy with. I'm not going to complain about my $160. And I was done with that by 11:15 and was able to do the rest of the stuff I needed to do today. And didn't even have to worry about it. I watched Jerome, you know, watch the trade, do all that it was doing because I run a community, but I didn't have to worry about that. All right. But I could have done this trade, let it go. It would have been out of the money and I would have made $360 today. And on a regular basis, on a daily basis, we would do this. I would do multiples of these contracts, let them expire worthless. And I can do these throughout the day. I can do them at 10, 11, 1, 2 o'clock, all the way up till literally 3:59 in the afternoon. I can enter trades at 3:59 in the afternoon and collect $50 and $60 per contract and have 1 minute. As long as the price doesn't come back through my strikes in 1 minute, I keep the money. It don't have to move at all. The price can literally, I can enter the trade and the price can just sit still and we can keep the money. All right. You can collect your premiums and you spend a short time in the trade, depending on how much time you want to be in it. Sometimes we're there all day if you choose to be. Sometimes you just wait till 2:30, 3 o'clock, 3:30, 3:45, because it seems like 3:45 is where things are getting to be crazy every day. So sometimes we wait till after 3:45. And there's no shares to exchange, just cash. Right? If you know how to chart, which many of you do, and if you don't, you're learning because TJ is teaching that all the time. You know how to look at some indicators and some charting things. then you can maybe look. I probably wouldn't suggest that you start off with SPX. That's like the big daddy. You don't start off with the big roller coaster. You ride the little roller coaster first. But I'm just saying there's opportunities in the buy space and in the sell space. Many people don't know that there's opportunities in the seller space. And that's what I'm here to do, right? The pros to selling, it can be passive, doesn't require much watching except for the 0DTE, which does require much watching. But if you're doing the credit spread, you can do that on any stock all week long. You can do that, any day, you can do the weeklies there for any of the other stocks. You get paid to trade. Your collateral requirement is low, just the width of the spread. Like I told you, the one spread on Triple Q is $100 minus whatever you take in premiums. You win in all your situations except one. You know exactly how much you're going to profit when you enter. Some people, are okay with that. So we be like, I want to know my winnings to be, undefined. Well, then you need to keep buying. If you're cool with knowing what is your set profit and your set amount of loss, then credit spreads is where you need to be. Cons to selling spreads: if the price breaches both your strikes, you are going to suffer the loss of the spread. That's where the max loss is going to come in. And returns can feel low in comparison to buying, because when you're buying options, you can, your winnings can go and go and go. When you're selling, if you decide you're taking $20 for that spread, that's all you're getting. You don't get to say, I'm taking $20 now, and if it goes the way you want, like, oh, I want more money. It doesn't work like that with selling. If you said I was going to sell it for 20, then that's what you're going to get. That's 20. That's the way it goes. Do we have any questions? All righty. All righty. Well, I'm going to hit this page real quick, and then I'm going to give the con back to TJ. So TJ, get ready to take over again. If you wanted to go deeper on any of these strategies, because of course I definitely hit it very superficially. The wheel strategy, which includes cash secure puts and covered calls, is generally regularly a $247 course, but I have 50% off for impact in case you decide you want more. I am a digital creator, so I do have trainings, right? I'm an educator. 123.50 for impact for you. You can use impact as your coupon code. If you wanted to do the spreads, you wanted to see about how to do credit spreads more perfectly, and even if you wanted debit spreads, if you wanted to do debit spreads, which is a buying strategy, I also have a training for that. Half price also $148.50, regular price $297. And if you wanted to work on just the SPX spreads, maybe you're like, I don't want the other stuff, I just want to do just SPX because that's where the money resides, then $147 for impact. Educator2trader.com is my website. You can use impact for your coupon code. If you didn't want to get it all in piecemeals, you could get the full bundle. The full bundle, the option seller bundle, includes all that stuff and includes short selling shares, and options 411 and creating a trading plan. All that's in there for $397 for the impact people, party people. All righty. If you aren't following me in all the places, here I am. I'm Educator2Trader in all of the places. I have a YouTube channel, social media, all the places, Educator2Trader, and you can email me if you need to. But of course, I'm in Impact. You can always find me there. I am there as well. All right. All right. TJ, you have the con.
Thank you so much, AP.
Uh-huh.
Y'all, I hope y'all were taking notes, really soaking in this game that AP dropped as far as option selling. You know, I'm not as vocal about the option selling that I do, but if you definitely want to be a full time trader, you're looking to do this at a higher level, you have to know both sides of the coin. Um, it's kind of like a basketball player, right? A basketball player that just knows how to play offense isn't as worthy as someone that can play two sides of the ball, right? So we want to make sure that we're not ignoring the value that is here. This is a major way, especially for some of you longer term folks, to leverage a lot of that capital that you just have sitting on the sidelines, right?
Mhm,
Cash that is not at work is losing value, especially in
mhm.
these inflationary times. So it's important that you make every dollar that you got do its fair share. All right. So, again, I appreciate AP for giving us a great lesson. I appreciate each one of you for coming out this evening. I know once this recording is available, we will post it in the class recaps channel. But until then, I hope each and every one of you have a blessed evening, and I hope to talk to you all tomorrow.
All righty.
Good night, everyone.
Thanks for hanging out with me. Goodbye, y'all.